and welcome to episode number 1 of the Comfort Lettings Ask the Expert series. Today I have with me Phil Ashford, who is our very own in-house expert and chartered accountant, and he is here to answer a question that's been put to us about a recent change to tax legislation and what impact that might have on property investors. So, first item on the agenda today was Clause 24. So we've heard lots about this in the news, but there's been some conflicting stories in the media, especially about what's happening, what it even means. So, Phil, if possible, could you set out very briefly, 30 seconds, what Clause 24 is, and then for the people listening, some of the considerations, so perhaps some of the things they need to think about.
Clause 24, it's also called Section 24 as well online, so you may have seen that. Really tough new piece of tax law that's coming in. So anyone who's borrowing money in their residential property investment, this really affects you. Those are the people who really need to be kind of looking at this and seeing how it affects them. But ultimately, before, if you bought an asset and borrowed money against it, you would be charged interest by the bank, and then you would use that interest as a deduction on your tax return. And that would limit the amount of profits that you are making on your property investment. What the government have done is said, no, you cannot now have it as an expense, full stop. Now they're phasing that in over 4 years, so actually the effect of this is only 25% this year, so this current tax year is when it came into force. Okay. But by 2020, the full effect of this will be there. And in its place, there will be effectively a mortgage interest relief calculation done. Now, that is limited to 20%. So if you spent £1,000 on your mortgage interest, you would be allowed a £200 reduction at the end. Now, for high rate taxpayers, they previously would have got £400 reduction. So in effect, they're having £200 taken off them for every £1,000 of interest charged. So it will have a material impact, but it does knock on to other things. So child tax credits calculations, looking at anyone who gets any kind of benefits, it will actually increase, artificially so, it'll increase your income, and effectively when the other departments from HMRC and various other bodies calculate what your entitlements might be, they very well will be affected as well. So really important to look at. Across a portfolio, if you're leveraged at 75% or above LTV, so a loan to value, if you've got a property worth 100,000 and you've got 75,000 pounds of borrowing on it, you really do need to pay attention to this, because actually one of the things that might happen is that you don't have enough cash to pay the tax bill at the end of the year, and you might need to supplement that out of your other income. So there's definitely some things to look out for, calculations to be done. It's fairly complex, but there are a lot of people in the industry now who can advise on it, and it's definitely worth speaking to your accountant if you haven't got one. Or indeed, our clients here are speaking to us about it.
Perfect. Okay. So I suppose in summary, it is going to affect anybody that's got borrowing against the property. That's mortgages
Absolutely.
against property.
So this is residential property. So those with commercial property, it doesn't affect that. And it's borrowings in your own name as well. So a lot of people are putting their properties into limited companies now, because limited companies will still get a full deduction.
Okay, perfect. And I suppose the other thing is fair to say is that it really there's a full financial picture that people need to consider with this. It's not just looking at their mortgages in isolation.
Yeah.
It's everything. There's impacts that it will have elsewhere. So if you haven't already spoken to your accountant about it, make sure you speak to them. Make sure that you make an assessment of all of your finances and where they sit. And certainly plan for that phased introduction. So I gather it's happening in phases.
That's right. So 25% of the full impact is happening right now. The other impact it will have actually is on your borrowing costs. So I'd expect your borrowing costs to go up, because in the eyes of the bank you are now more risky. In effect, you have less money with which to pay off your loan, and therefore the mortgage companies are going to increase the risk on you, and therefore the cost of borrowing will go up. It will mean actually as well lengthier applications for finance. They're going to have to look a lot more deeply into exactly what your financial position is, and indeed do your tax calculations for you, projected forwards, to figure out, how do you have enough cash to even service the loan. So it will have a knock-on impact. So expect longer transaction times, more expensive financing, and higher tax bills.
Okay, well, hopefully that's been a really useful video, something to think about, and something hopefully which allows you to plan and obviously make the right decisions for your investments going forward. We've got another Ask the Expert slot coming up, and details of that will be in the link below. Please click on it, and if you've got any questions about this video or would like to have any questions answered in future videos, please also leave those in the comments for us later on. Thanks for watching.